Good afternoon, everybody. I'd like to welcome you on behalf of the Geneva Graduate Institute and the Center for Finance of Development to this public panel on leveraging technology to advance financial inclusion in the private sector. So we have our director here as well. You can replace me if you want. But So thank you all for coming here. And it's a joint event with the Center for Finance and Development and the World Bank Group. I'm not going to spoil our first speaker's notes, but say a couple words about the importance of financial inclusion and growth. And that's part of the work we've been doing at the Center for Finance and Development here at the Graduate Institute and also with the Swiss Lab for Sustainable Finance that I'm directing. And it's financial inclusion has been historically a major contributor to economic growth in Western societies, in what we now call the advanced societies. And based on that long-term historical perspective, it's definitely something that will enhance the lesser developed economies, which are the focus of most of the discussion here, where financial inclusion still needs to take place today. Now, in terms of its relationship to the SDG goals, so there are actually a couple of SDG goals. I noted them down because of all these acronyms. It's 8.10.1 and 8.10.2 that are related directly to financial inclusion. One of them is the number of bank branches, and probably you created them, right? You provide the data, you'll talk about it in a minute, to these two SDG goals. So one of them is the bank branches per capita, and the other one is accounts in financial institutions per capita. But the role of financial inclusion or financial development in the SDG doesn't end with 2 out of 100 and some SDG indicators, because financial inclusion is key as a key enabler to many other SDG goals and has huge impact on a variety of them. And financial inclusion is definitely a major source of economic growth. Going back to history, we know that financial development has helped Western societies a lot, but we also know, and we're today in some sense victims of some of that success, and part of the, when you're doing financial inclusion and financial growth, you also have to worry about sustainability as well. So these has to be done. Now we know, based on the European experience, that these have to be done in a sustainable way. So this is kind of the challenge ahead, to both increase inclusion, but also do it in a sustainable way and avoid some of the pitfalls that the financial industry has created for the advanced economies, on top of the good things they did. So without further ado, and I don't want to spoil Laura's introduction, so let me introduce Laura Klapper, who is a lead economist in the Development Research Group at the World Bank. She's the founder of the Global Findex database that she will present in a few minutes on financial inclusion. She directed the report, the World Development Report on financing the equitable recovery from COVID, which is a report that was released in 2022. Of course, she published extensively in journals, in finance, corporate finance, and fintech, banking, and entrepreneurship. A very distinguished list of publications and citation. And she holds a PhD from the Stern Business School at NYU. And without further ado, I'd like to invite Laura to give the key opening 20 minutes of the event. Thank you.
Thank you, Dr. Sussman, for that nice introduction. So I often get asked when I present the work, I'm sorry, am I able to see my, if we can get, sorry. I'm often asked the question of, aren't bank accounts expensive? Why aren't they designed for rich people? Why are we pushing for every adult to have their own account, especially women? Why don't they just use their husband's account? And as was briefly mentioned, the World Bank defines financial inclusion as both access and use of formal financial services responsibly, sustainably, in a well-regulated environment. And what I hope to convince you in my presentation is that access to financial services, especially digital services, is far more than just a convenience. I'll discuss some research as we go along, but certainly it points to the importance of access to financial services for people to save, to borrow, to invest in business, educational opportunities, to pull themselves out of poverty. It also helps people save, have insurance, to prevent them from falling into poverty if a disaster hits. And also, quite importantly, it creates greater transparency, greater visibility, digital payments, something regulators are interested in, but also increasingly banks with responsible use of machine learning, artificial intelligence, alternative credit data to provide access to credit for people who may not have other collateral. So just to summarize very briefly the literature, I apologize, I can't see my slides from here. So if I'm turning it around. Digital financial services offer greater privacy, security, and control over the money. There's evidence showing that if people are paid into an account instead of walking home with a wad of cash in their pocket, it's safer for them. It also decreases impulse spending. It also can reduce the euphemism leakage, can reduce corruption. When governments make payments directly into someone's account, there's less risk that money gets lost along the way. It can also help people meet unanticipated expenses. So often the digitization of payments is the first step into the formal financial system and encourages saving, access, building a payment history that can lead to access to appropriate credit. So I'm going to talk a little bit about summarize data from the Global Findex database. This is the world's first comparable, harmonized data set on the use of formal financial services, how people save, borrow, make payments, and manage their risks. Data is funded by Bill and Melinda Gates Foundation, the MasterCard Foundation. We've been asking over the past decade, about every 3 years, we interview about 150,000 people around the world on their use of financial services. Importantly, the data is randomized on a national level, which means that we can splice and dice the data by gender, income, age, employment status, rural residence, and more. And the data has been used to measure financial inclusion. We always say you can't solve a problem you can't measure, to identify gaps in the data, to design policies and products, and to track progress over time. It's also encouraged greater rigorous research. We can't, from cross-sectional data, really talk about impact or causality, but the data has led to a number of studies done by people in the room. For example, looking what is the real benefits of digital payments? Does it really matter if you hand someone cash or pay them into an account? And the evidence is pointing to these benefits. So just to give you the high-level overview, so we were in the field in 2020 when the world shut down. And so we quickly pivoted in 2021. We delayed for a year the data collection and added some new questions on the use of financial services during the pandemic. Remembering that even 2021 wasn't an ordinary year, I will mention that as well. So first big punchline is a tremendous use of technology-enabled financial services. This includes biometric identification, includes mobile banking, mobile money accounts, digital, and more. In sub-Saharan Africa, mobile money accounts offered by telecoms, offered by fintechs in Bangladesh and Paraguay, are really driving financial inclusion. So these are accounts offered by the mobile phone agents who are now the local banker. Rather than have to travel to the city, you can access financial services in your home village. Often people are more comfortable with the local agents. Women in particular may have restrictions on traveling to the city because of family, social responsibilities, and social norms. And we're seeing a big take-up, especially by younger adults. In sub-Saharan Africa, there's a big gender gap in the use of bank accounts among younger adults, whereas we find no gender gap between men and women under 35 in the use of mobile money accounts. Leading to my next point, gender. Globally, for the first time in 10 years, the gender gap has narrowed. On average, with a big caveat that because it's survey data, all data is population weighted on the country level, which means that India and China count a lot. But globally, we see the gender gap in the use of in ownership of accounts drop to 6 percentage points globally. But that does mask some bigger gaps, especially in South Asia, in the Middle East and North Africa. And interestingly, we'll talk about in some sub-Saharan African countries where the gap actually increased to 12 percentage points. And finally, During the pandemic, there was massive adoption of digital payments. Governments trying to get money quickly to people in need made payments directly into accounts at banks and on their phone. Many employers digitized wages. In addition, digital payments became a lifeline for small businesses during when cash was perceived as unsanitary and during mobility restrictions. And so we saw this big take-up of digital payments. I think one of the big questions of the next round of data, which we will be collecting in 2024, is was it sustainable? I can only talk from the experience of the Italian bakery where I grew up in New York, which never took digital payments during the pandemic, had a sign, we now take cards. And last summer has a big sign, we take cash only, exclamation mark. And when I asked them why, they said, well, older people are uncomfortable and our accountant told us it was a bad idea. So it'll be interesting to see globally what continues. So on a global scale, the map's gotten a lot darker over time. Today, 76% of adults around the world have an account. That's more than a 30 percentage point increase than when we first started collecting the data. In developing countries, over 70% of adults have an account. So just to focus on a couple of big economies, and really there's different drivers, which is beyond the scope of this presentation, but Brazil, which digitized all government payments, wage payments, transfer payments, people opening accounts to receive their payments. In China, with the growth of Alipay, WeChat, people opening accounts have access to digital payments to make transactions. In India, where the government leveraged the biometric Aadhaar numbers and the JDY account policy, which required banks to offer simple no-fee accounts. Although India is an interesting example, globally, less than 5% of adults who have an account don't use it. People are using their accounts. In India, 2/3 of accounts, people say they haven't used for a single transaction in the past year, which again raises the importance of policies to expand financial inclusion and account ownership being linked to use cases and the development of the ecosystem. And of course, Kenya, the first really early adopter of mobile money accounts, where virtually the entire economy today is digitized. So also just to hone in on Africa for a moment. So this is splicing the data by the African Union's definitions of sub-regional definitions. Where we see, again, the purple are people who use only a mobile money account. So really on the margin. And we see over the past 4 years, virtually all growth was driven by this marginal piece of adults using only mobile money accounts. In Central Africa, Eastern, Western. North Africa, where the regulations don't support mobile money accounts, fintech competition has really seen no growth and has really lagged behind. I also must mention that Nigeria and Ethiopia, two very populous countries, at least at the time of our data collection, didn't have the regulations to support mobile money. As an interesting aside, Nigeria has the largest gender gap in the region. So importantly, we're interested in equitable access to financial accounts. So this is this is for globally developing countries only. We see this narrowing slightly of the gender gap. We definitely see it across countries, especially in East Asia, which have the biggest gaps, narrowing of the income gap. That's again, I'll talk about in a moment, the importance of mobile banking, mobile accounts, which generally have a different cost structure. However, the education gap is pretty stuck. This is also because as more people become banked, the majority in Africa, for example, of the unbanked have only a primary education or less. And this really highlights the importance, we'll hear more from Lori and Xavi tomorrow, the importance of consumer protection, of making sure that not only do people have the education, have the skills to use accounts safely on their own, but also the importance of a consumer protection framework to ensure users are being given complete and not misleading information. And so we ask the unbanked, the beauty of demand-side data is we can ask the unbanked, why don't you have an account? And so across developing countries, we hear they're too expensive, or they're too far away, or I just use somebody else's account because it's too expensive for me to have my own. And so mobile money is really, and banking, is really an example of how to address those barriers. As I mentioned, they're offered locally in your village so that often we no longer hear about distance. It also has a different cost structure. So take a step back. When you think about the financial lives of the poor, it may be day laborers or people who are paid daily for their wages. They tend to have they typically only have enough money to buy food for one day. Poorer adults are making very high frequency, low denomination payments. importantly, I always say the most important payment is to oneself in the form of savings. We hear around the world how important it is for people to try to save $1 a day or small amounts on a high-frequency basis safely outside their home. And banks aren't really designed the cost structure for these high-frequency, low-denomination payments, but mobile money is. There's no fee to deposit the money. The fee is when you withdraw or make the payment. And we've seen, again, this massive adoption, especially by poor adults, by women, countries in West Africa where more women than men have mobile money accounts. And really what you can see here is, I think, really dramatic, this increase in the adoption of mobile money across the continent. What was really an East African story when we started collecting the data has spread across the continent. And so, but yet, when we think we focus on equitable access to accounts, when we look at the data for sub-Saharan Africa, we see this growing gender gap. Interesting aside, during the pandemic, for example, Cote d'Ivoire digitized their government payments to male, head of household, typically male, to self-employed, typically male, and to get people quickly the money in need. But it actually, we see an increase of a spike in the adoption of mobile money accounts by men and women being left behind. Bangladesh, in comparison, targeted mothers in most of their COVID programs, and we actually saw a slashing of the gender gap. Just a suggestion that policies really matter. We also see a big education gap. Again, the focus on the importance of giving people the skills and designing the products for less educated and financially experienced users. Continue to see an income gap. Interestingly, we don't see an age gap, and that's again driven by the big adoption of technology-enabled accounts by younger adults. So we ask only in Africa, the unbanked, people who don't have a mobile money account, why don't you have a mobile money account? And here the biggest barrier is simply not having access to a phone. This is affordability, although less so. ID, again, less so. What's really driving this when we dig into the data, we look at data by the GSM Association, which is a London-based umbrella group of mobile phone operators. The biggest gap is simply connectivity. And highlighting again the importance that the flip side of financial inclusion is you got to have a digital public investment in digital ID, in the digital infrastructure, the connectivity. And just a little bit food for thought. So we also have data we collect with our colleagues in the ID4D team at the World Bank, and we have on phone ownership, we're actually going to expand our connectivity questions next year. We see this really tight relationship between the ID gap, the phone gap, and the account ownership gap across countries. And this makes sense. When we asked people in 2017, how do you use your ID? To my surprise, by a multiple of 4, the number one reason was to access to buy a mobile phone. Because there's know your customer KYC requirements to have your own SIMS card in your phone, which is required to have a mobile money account. And so this is all these relationships are tightly linked. You have to have ID to have a phone. You need the phone in your own name to have your mobile money account. And so investments and development policies targeting all 3 are really required. And just to mention, we also asked the question, and we're asking this question even better in the next round. Some new questions we couldn't pilot during COVID. But just, can you use your mobile account on your own without help? Again, this goes back to research by Laurie and Xavi, and just the risks that when you use an agent, when you ask an agent for help, there's the potential to have illicit fees. And so as you can see here, about 30% of adults in sub-Saharan Africa say they have to ask someone for help. Again, at least exposing them to the risk of financial fraud and abuse. Okay, before I continue, and I'm just going to talk a little bit about use cases. So this is perhaps the most surprising figure in our report. My own colleagues were like, mobile money, that's just to send money around town. If you can't pay your bar tab, you ask a friend to send you a little money. That's no longer the case. Mobile money is so this is of the 33% of adults in sub-Saharan Africa who have a mobile money account, and that number is twice as high in many countries. Remember, Nigeria and Ethiopia are holding back our regional average. But of that 33%, we find about 20% saving, using their, 20%, I can't see here, I should know this by heart. 20% borrowing money through their account, although that's I need to put an asterisk there. I was piloting a few weeks ago in Malawi and Zambia, and I discovered that probably most of that is buying mobile minutes on credit. So we'll have better data next year. But about 40% say they use their mobile money account to save. And this was a surprise to us. Very few countries have savings products. Almost no countries pay interest. But it's adults realizing that they can store their money safely outside their home. And again, this was not random, but it was representative. When I was in Malawi and Zambia, I spoke to about 40 people over the course of a week. I think every person I spoke to said they opened their mobile money account to save money. I said to them, well, do you make payments? Like, no, I'm poor, I have no money. But I used to give the money to my wife to save, or I try to keep it in my pocket, and I deposit into my mobile money account $1 a week so I could buy a motorbike. And just people realizing the opportunity and the convenience and having a safe place to store money outside the home. And again, so the mobile money accounts are being used for much more than payments. So I guess to very briefly run through some use cases. In government payments, we see here not only are governments making payments into bank accounts, they're leveraging mobile money accounts, which again makes it easier and safer for people to withdraw the money locally, and hopefully cut down on corruption, get money to people quickly. It also offers opportunities in the insurance realm. Rather than offers public health, you can target subsidies and various other programs because you can direct money to people, even in rural areas. We also ask about, it's just to say, we also, in the report, go through a number of cases where we can actually quantify what are the number of people who are unbanked and receive government payments in cash. And this is, again, important for policymakers, practitioners, researchers to understand where are the opportunities. We also look at private wage payments, and here you can see how the variation even within Asia. This is important because, and I've done some work in Bangladesh, showing that when you pay people into an account, rather than people who only have a bank account but receive their wage payments in cash, their savings more than doubles. They become more resilient, less likely to go hungry at the end of the month. They also become more financially savvier customers. There's a learning by doing, that by using their account after a few months of seeing that their money's safe in the account, they very quickly start using their accounts to save and just to manage their money over the month. And here it's also interesting that it's being led by the big buyers. Marks and Spencer, H&M, The Gap are telling factories, you have to pay your workers electronically or we're going to pull out. And that's because of the pressures from their shareholders to have electronic proof of fair wages. But something that countries are very aware of, and it's really quite interesting why we continue to see this variation. Both the ability, the digital development, but also resistance on behalf of not only workers, but also of unions in some countries. And we'll have Valerie from the ILO talk more about this in a few minutes. And then agricultural payments. This is one area where it's really lagging behind, in the sense of most agricultural payments are still made in cash, although farmers are potentially tremendous beneficiaries of having that formal relationship. You can think about access to seed, fertilizer, other insurance products, and a number of new models of embedded finance. What that means is effectively collateralizing future cash flow. By making arrangements with ultimate buyers, the lender can be paid first before the farmer, embedding the finance. And there are interesting models in India, for example, where you could finance better quality seeds. The quality of the seeds is related to the quality of the output in order to line up the buyers to embed the financing. Okay, switching gears, we also care about how do you make payments, keeping the money digital, the development of this digital ecosystem. We also care because a small business owner, even informal, who receives digital payments, can build that payment history, can build as a product Confio in Mexico, which is again created in embedded finance models. Small merchants can borrow and the lender is paid directly from the future cash flows. Here we see tremendous adoption in Latin America, for example, which always had the digital readiness. They had the infrastructure, but issues around taxation and formalization prevented the adoption of digital payments. We saw 40% of adults in Latin America making a merchant payment during COVID, and almost 40% of whom made their first payment after the start of the pandemic. And then finally, this is looking just at sub-Saharan Africa around savings, just seeing a wildly large adoption of mobile money accounts for savings. Now, there's a caveat. Before 2017, we simply asked, do you save at a formal financial institution where you should have included your mobile money account, but maybe you didn't. Regardless, we see shrinking of saving under the mattress, saving semi-formally. These are not only savings groups, but also in West Africa, you often pay someone to collect your money, to save outside the home, and really this big adoption of mobile money. And somewhere I expect growth, see more growth next year. And if I have, I'm over time. So I'm just going to leave that at, so I hope I've convinced you on the importance of digital payments as far more than convenience, and also just the importance to help people build the resilience so they have money when their family's in need. So thank you.
So good evening, everyone. So I'm Lore van der Walle. I'm an associate professor here at the Graduate Institute, and I'll be moderating the panel. So Leora has been introduced already, but let me also introduce the other panelists. So next to Leora, we have Liliana de Sa-Kirchhoff. Liliana has been working for the Swiss State Secretariat of Economic Affairs, also probably even better known as SECO, since 1996. She's currently the head of the Private Sector Development Division in the Economic Development Cooperation Directorate. Her division promotes a better business environment and access to finance, and strengthens skills for companies to foster entrepreneurship and innovation. So two aspects that are very important in the division are currently sustainable finance and also impact investment. So next to Liliana, there is Chris Woodruff, so leading to some particular economic diversity this evening, surrounded by women. So Chris is a professor of development economics at Oxford University. So Chris's research focuses on a wide range of topics related to enterprises in low-income countries, including on the returns to capital investments in microenterprises. So no PhD student has missed this paper for sure, if they are at the Graduate Institute. Then also the effect of formal registration on enterprise performance and the challenges that women face in moving into supervisory roles in the garment sector in Bangladesh. So Chris is also the scientific coordinator of PEDAL. So PEDAL is the DFID-CPR joint research venture on private enterprise development in low-income countries. And he's also leading the firm capabilities group at the International Growth Center. Okay, so the IGC he's also working for. So then last we have Valérie Breda. So Valérie has over 12 years of experience in financial inclusion and currently works as a senior technical officer at the International Labour Organization's Social Finance Program. She leads the ILO's efforts to promote the transition from cash to responsible digital wage payments and coordinates, in addition, the Global Center on Digital Wages for decent work. Okay, so we have a couple of questions for the panel before we're then opening the room to a Q&A from the audience as well. So I'm going to start with asking a question to Liliana. So as we just saw from the presentation, there are currently about 1.4 billion of unbanked people. And that indicates that there's still a number of challenges in inclusive access to finance, okay, in particular for SMEs, in particular for women. So the main question to you is, what can governments actually do to expand inclusive access to finance?
Thank you very much, and pleasure to be here. Just to explain briefly, SECO is part of a government entity for the Swiss Official Development Assistance. So one part of the funds are channeled through SECO, and we mainly focus on economic reforms. So with regard to what governments can do and how we also can support them, one part to start is certainly to have a national financial inclusion strategy, because that helps governments to analyze where they stand and to define ambition goals with regard, for example, also specifically to women, but also SMEs, and to see where they want to be in a couple of years and define also indicators. And why SMEs are so important? Because they actually provide 30% of the jobs in low-income countries. So when we talk about private sector growth, it's important that SMEs also have access to finance. And currently about 60% of the formal SMEs in emerging markets are not served by financial institutions. So we do have a huge gap. What we see, and we work, for example, with the World Bank on financial inclusion agendas in South Africa or in Indonesia, and it's really a multi-stakeholder process with many ministries involved, and we see that we need to balance the stability side, where ministries of finances or central banks are looking at, with the financial inclusion side, where other ministries are in the lead. And sometimes it's not so easy to reach a consensus on that. The national financial inclusion strategy will also identify digital gaps in the digital infrastructure, right? Because without access to the internet, you cannot use any financial services. And for instance, in Africa, in rural areas, less than 10% have some form of digital connectivity. So it's a huge challenge, and we do need to narrow this gap. And that's where we have, again, the multilateral development banks like the World Bank or the African Development Bank, which we are shareholders of, where we need to see how they can provide funds to actually put in place this infrastructure. What is also important are, of course, sound regulatory frameworks, because you really want to make sure that this regulation is in place that promotes also inclusion to women. And there, for example, we work together with the World Women's Banking that advise governments in that respect, and that's really important. And we have seen that, as mentioned by you, Leora, that digitalizing payments is an important way to expand financial inclusion. And the Better Than Cash Alliance, with whom we also work, they have during COVID worked, for instance, with the Colombian government on a program called Ingreso Solidario, where they have done digital payments, emergency welfare digital payments. And this aid mechanism then was extended beyond COVID and reached an additional 1 million households, and now they reached 4 million. And interestingly, 60% are women-led households. So we make sure that women are really also included on that. I wanted to mention a last example concretely on Ghana, where we have worked with IFC and CGAP, group to assist the poor on advancing digital financial services. We worked at different levels. I think the microphone is maybe not always working.
Wait, we can change.
I think it's not so pleasant for you otherwise. So we have worked at different levels, at the government level, but also with the financial sector. And as a result, the project contributed to the reduction of the unbanked population in Ghana from 60% to 42%. That was by the end of 2021, after a 5-year implementation. And out of the new users, 43% were women. And the total value of transactions per month grew 9-fold. So I think these are encouraging results, and these are ways how we can work with different partners, international partners, on assisting governments to make progress.
Some new microphones. There we go. The magic button. So thank you very much for this. So I want to continue a bit on the digital payments, because this made a very large difference during the pandemic, because more and more people started making these digital payments. So the big question, though, is that now that people got used to this technology, how can we further leverage this to also increase the use of formal savings, borrowing? So Valérie, can you tell us something on this?
Yes, thank you, Laure, and thank you for inviting me. I will talk a little bit on wage payment, because this is what I'm focusing on at the moment at the ILO. So we have seen that, of course, during the pandemic, in all the countries where we are working, in 6 countries, we have seen that and I think it's true in all the countries, during the pandemic, we have seen an increase of the use of digital payments and digital wage payments in particular. As a way to of course, to pay workers without human contact, as a way to reach also workers when they were sent back to their villages, for example. So using digital wage payments helped a lot during the pandemic, and we have seen in a number of countries actually a huge increase that was facilitated by regulations, new regulations to help enterprises to make the shift, or to require enterprises to make the shift. But maybe what I would like to say is that using wage payment as a way to increase financial inclusion of workers is excellent. And we know from the Findex that there are over 165 million workers who are unbanked and who are working in the private sector and who are still using or still receiving their wages in cash. We were discussing actually with Leora this afternoon that this is looking at workers who are unbanked, but many more workers, many hundreds of millions of workers may have an account but still receive their wages in cash. So for us at the ILO, we are looking at this wage payments through digital methods as a way also to protect the wages of the workers, because the wages are more accurate, because they are paid timely, because it is safer, because it lessens the risk of non-payment of wages. So in addition to increasing financial inclusion of the workers, we also see that it's a very strong factor to protect the wages of the workers. And you may have followed that last week there was the International Labour Conference in Geneva. You may have met many delegates, because there were thousands of delegates in the city. And this is, this was mentioned, the digital wage payments were mentioned as a way to protect the workers against the non-payment of wages. So this is, at the ILO, we are looking at it as a way to improve financial inclusion, boost the use of financial services, but also as a way to protect the workers, and thirdly, as a way to promote sustainable enterprises, because we do believe there is also a business case for enterprises to transition. But what we have seen actually is that paying wages digitally enables workers to have access to a bank account, but it doesn't mean that they are using their bank account. And we have seen in many countries that workers tend to cash out their wages on payday or around payday, and 100% of their wages. Meaning that, yes, paying wages digitally is one way to increase financial inclusion, but it is not enough. If the workers are cashing out on payday, then it's a good thing for the enterprise that gain in efficiencies, etc. But for the workers, it doesn't make much difference, and often it is also costly for them to have access to their wage. So we really have to look at this digitization of wage payment as a good way to promote financial inclusion, but it has to be done in a responsible manner. So this is what we are promoting, doing it in a responsible manner so that the workers can also benefit from this digital wage payments and use other financial services. Like savings, and Leora has mentioned that very clearly, that it's a way for workers to have access to a formal savings product, and it's a way for workers to be able to save in a safe manner. So from a couple of studies that have been done, we see that when workers are paid digitally, They are having a hard time at the beginning, of course. Change is always difficult for everyone. But after a couple of months, after several months, actually, we see that their savings are increasing. So meaning that even though it may not easy for workers to adopt digital wage payments, it helps them to save little by little. We also see it as a way to have access to loans, as receiving wage payments will enable workers to have a proof of payment, or to have, in some cases, they receive, I mean, this is what we are promoting, they would receive a pay slip. And with this proof of payment into a bank account, then it is easier for them to have access to loans, including housing loans, for example. And it contributes to improving their opportunities and their resilience. We are also looking at how it can contribute to helping workers to have a better access to insurance. So first, health insurance, which we do believe that being paid digitally on a bank account or a mobile money account, as it provides transparency, or greater transparency, it can encourage also enterprises to contribute to social security system for their workers, meaning that the workers would have access to social security in the country. And also how paying wages digitally enable workers to have access to other kinds of insurance or private health insurance, etc. So for us, really, it shows that paying wages digitally brings some benefits for the workers in terms of having an account, in terms of having a safe place to keep their savings, in terms of having access to other services like loans. What we are also seeing in more and more countries is that workers being paid digitally have access to a product that is called earned wage access. So basically they have access to a salary advance that is provided not by the enterprises as it may done traditionally, but by an external provider. So it's another financial service that workers being paid digitally can have access, even though there are challenges also on the way. Of course, there are other challenges on the way, actually, when we are looking at using technology to increase financial inclusion, and many have been mentioned when it comes to infrastructure, when it comes to cost for the workers and for the individuals. Kenya has been mentioned a few times because it's a kind of success story in terms of adoption of mobile money as a way to increase financial inclusion. When we did an assessment a few months ago there, actually, I was very surprised. We learned from the workers that mobile money was still very expensive for them. So even though it is used very broadly in the country, it remains costly for workers to use it. To answer, well, not to answer, but to address the Leora's comments on the trade unions that may be resisting in some countries to digitize wage payments. This is not what we have experienced in the different countries where we are working. We are also working at global level with the International Trade Union Confederation. From our experience, the trade unions are supporting this agenda of digitizing wage payment, as it promotes fair wages and it promotes transparency. And I think I spoke too much already, no? So I'll
very
continue
interesting.
later.
Thank you very much for this. So now that we're talking about digital payments, so that brought us to the aspect that it can help in increasing savings, and one reason why savings are so important, and particularly for the poor, because it remains a very important aspect to help smooth consumption, to build up resilience. But as we also heard, it's not necessarily sufficient, because if you take a look at the global Findex results, 2/3 of households, in case that they're facing an emergency, they actually do not have the money available to overcome that. So Chris, is there any lessons that we can learn from academics on what we actually can do. Wait, that doesn't look positive. On what we actually can do to help poor households to further build up on resilience.
Well, let me say, first of all, it's increasingly hard to say anything that hasn't already been said. So that's point one. And point two is academics don't have answers; they have questions. So I'm gonna. In fact, I'm kind of intrigued by what's behind the slide there. That's the social networks, and that's one of the points I want to raise and sort of ask some questions about. But so let me say first, thanks for inviting me for this, and thanks for the wonderful discussion and comments already so far. I think, Leora, you said, savings for resilience, and you see savings accounts and so forth. That's obviously the first thing that we do see this. Valerie, you mentioned wage payments in advance. That's another place where obviously the digital payments can have a big effect. I want to raise a couple of points. One which is more of a point, and the other which will be more of a question about what we might think would be sort of a knock-on effect or that might come from this. The first point is to say that I think that the basic mobile money digital payments platforms are just that. They're a platform. They're a platform that a whole lot of stuff is going to be built on top of. And digital wage payments are one, but I have colleagues at Oxford, Stefan Durkin and others, who are working on thinking about sort of predictable disasters, short-run predictable disasters. So think of a flood downriver where the water is coming and you're going to have a flood, and being able to make payments in advance, sort of basically, payments in advance of the flood to households to allow them to prepare and react on short notice, to move things, to rearrange activities and so forth, to be able to prepare for the coming disaster. And I think that's something that, how do you get the money to people in advance? You can't really drive trucks out to all these places. You have to do it quickly and rapidly, and you have to, and on a very wide spread scale. Digital accounts that are widespread. Now, that if you're going to reach the poorest, that means you have to have really high penetration rates, and so you have to be able to have access to that. But I think that's the kind of thing we're probably not there yet, but that there's potential for these kinds of programs and these kinds of payments that may be quite important. The other thing that comes to mind that maybe is, to me, more of a question and kind of how are we going to think about this is that if you think about resilience now, the resilience comes mostly from informal networks and trading. Now, it seems to me digital payments do two things, one positive and one maybe not so positive in terms of making these informal networks work. The positive one is that your informal network isn't so geographically limited anymore. It's much easier to reach people who are at a long distance, and you can have, and we saw this with Tavneet Suri and Billy Jack's work with M-Pesa in Kenya, and that people expand their networks much more geographically. They reach out to the villages. We see similar things in Bangladesh with payments from garment workers back to the village and so forth. So the digital payments allow you to do that in a way that was much more cumbersome, before we had sort of widespread mobile money platforms and so forth. But on the other hand, they may lead to certain people in these informal networks exiting the network and going into the formal sector, because they do have now a payments record. They have access to formal credit. Maybe they feel like they're the ones that tend to be net payers in their informal network, and therefore wouldn't it be a good thing if I could get out? And we do see some indication of people using savings accounts and formal savings accounts as a way to hide income and hide money, that we can wonder what will happen with that. And then similarly we can wonder what happens to informal savings associations like Roscas and so forth, and whether those will be affected by individuals being able to to use the more formal savings networks. And I'll say, you know, one of the companies that I find quite intriguing, and one of the roles that I now have that you didn't mention, Laura, is that I'm now on the board of the British International Investment, the DFI from the UK, and we have an investment in an Egyptian company which is basically doing online Roscas. And so, you know, if you're in most communities, you may have 2 or 3 people who trust you enough and who you trust enough to join a Rosca, that are organizers of Roscas, to join a Rosca with them, to join a rotating savings and credit association with. And that's going to be quite limited. You might want to be able to pay in $10 a month for 18 months and get a payment, and the best might be that you can pay in 20, you know, you just don't have that kind of. So these online Roscas, if they work, are going to offer you a menu which is much more extensive, which you'll be able to go into. Now the question is whether this is actually going to be stable, and whether you'll be able to and this is, I think, comes to the regulatory regimes, the ability to trace people, things like the universal payments interfaces that allow you to not renege in one Rosca and go to a different one, that where your reputation gets carried across. And I think we are going to have to think hard about what the regulatory background and the infrastructure to the digital payments systems are that make it so that these are universal enough and and where the incentives are more or less the same as they are in very small groups, informal networks that lead to, you know, robust systems that are maintained where people are able to substitute these digital payment systems for the informal, more social network-based payment systems that I'm sure is in the next slides that Gloria would have said. So I can bring this up because she didn't get a chance to say this already. So anyway, thank you. I'll stop there.
That was done on purpose. Okay, so I actually have a question about mobile banking for Leora, but now that Chris touched upon regulation, let me actually first continue the conversation there, because of course there are 2 aspects. If you want people to use account, it implies that we have to make sure that they understand the benefits of it, and that we can make sure that they know why it can be useful and how to use it. On the other hand, there's also the aspects of risk. And so, Liliana and Valérie, can you say something about, first of all, how can we help households in being better understanding the use of it and getting them on board and using it? But then also, how can we make sure that they're strong enough safeguards to actually protect households? So, you want to start?
Shall I start?
Yeah.
Yeah, so as you mentioned, really policy and regulation is key, and there are different levels of looking at it. So, for example, the Global Partnership for Financial Inclusion, GPFI, works under the G20 to look at some of these issues, and also to get to a common understanding between the different countries, G20 and also non-G20 countries that participate in this discussion. So we're also part of them, and we emphasize that, for example, consumer protection, data protection, and so on are important points when making progress in digitalizing further. But then you have, for example, also the UN Responsible Principles for Digital Payments. They have been elaborated by the Better Than Cash Alliance. These are kind of high-level principles that are important, that when you talk about regulation, that you keep them in mind, and you know, you're addressing them in defining the regulation. But then, of course, consumer protection, you know, you have, for example, 2-factor authentication when you log in, that can help to prevent fraud. Cybersecurity is now a big topic, right? We were just last week attacked in Switzerland on a big scale. and transparency issues. And since we are in Geneva, let me mention also the ITU, the International Telecommunications Union, right? They are involved in these discussions. There is a development finance services security lab that provides resources for conducting security tests for mobile payments applications. Again, here, when it comes to regulation, it's a fine line between allowing enough innovation so that innovation happens when we look at blockchain and so on. But at the same time, you need to have enough clear regulation that the protection is there. But yeah, again, that's sometimes a fine line, and you may want to have also recourse mechanisms in your regulation. Another aspect when you look at protecting the consumer, it's about credit history, because credit history provides on the one hand transparency for the financial institutions that provide financing, but it also helps the client to become indebted. And a very interesting collaboration that we entered with the IFC on making this data available cross-border is for Ukrainian refugees, because basically through this collaboration with the IFC, we were able with 9 countries to connect, to establish, to help verify the credit history and to make sure that financial institutions can exchange this information so that then the Ukrainians outside their country can actually access finance and establish again economic activities in their host countries. So that's an interesting way to look at that. And a final aspect is, of course, also financial education and literacy. You can work with different groups on that. One example is, again, smallholder farmers. We had a collaboration in Indonesia in the cacao sector where we had public-private partnership. The World Bank was also included. We from SECO provided some support, but then, Nestle, Mars, and others were part of it. And where you really want to also make sure that the smallholder farmers are trained in financial literacy, so they know how they can best access finance and how they can make best productive use of it.
Thank you. No, I'm in the same position. I'm going to repeat a little bit what Liliana has said. But maybe to share an example on consumer protection and data protection. Last week during this International Labour Conference, we had the opportunity to meet with an employers organization from Mexico. And one of the members of this organization was an entrepreneur, and he was sharing with us that one of his employees had come to the office in tears in the morning and telling him that she had accessed a digital loan using her phone and that she didn't repay on time, so the lender actually sent a message to all her contacts of her mobile phone. So putting herself in a awkward position, right? So and I had heard actually the same story in Kenya last November when I was there. So those things are common. So we can promote digital payments, we can promote digital financial services, but we need very strong safeguards and very strong consumer protection and data protection frameworks to make it work. And actually, when I was in Kenya last November, hearing this story, I heard also that the central bank issued a regulation to better monitor the digital lenders, asking for a number of requirements, and as a result, I don't know, like something like 10 or 15 digital lenders closed down, actually, because they were not able to meet those requirements. So again, very important to have those frameworks in place. And another thing I wanted to share is that a few months ago, I was discussing, I was on a call with the central bank in the Philippines, discussing about digital wage payments and how we could support their efforts to promote the transition. And they were telling me, well, in the Philippines, the regulatory frameworks are in place, the solutions are in place. We even have savings products online that with an interest. So it's not only a place to save your savings, but you can also earn some money. So the infrastructure is expanding. So we are reaching out to more remote areas, but still the adoption is not picking up. What can we do to make people adopt those digital payments? From our assessments, we heard actually that the workers in particular very often mistrust financial institutions, and in particular digital financial institutions, for the reasons that I have mentioned, also because of frauds, because of sometimes it's because of ignorance also, they're not confident, but in many countries still the regulatory frameworks are too weak to protect the workers. Another aspect why they are resisting is of course related to the financial literacy level, digital and financial literacy level that may be still too limited to enable them to adopt smoothly the digital payments and digital wage payments in particular. So we are working also on financial education, helping workers and also small entrepreneurs, because we have noticed that small entrepreneurs are also facing challenges when it comes to financial literacy. So we're building their capacities in doing that, using financial service providers as multipliers, using trade unions, government institutions to make sure that the knowledge can be transferred to the users so that they can adopt more easily, provided all the other conditions are filled. But it makes me think of something you have mentioned actually before, like we in Europe and in developed countries, we have gone through this same process 30, 40, 50 years ago. And when we were looking actually at the history in the UK in particular, we were actually wondering what should come first. Shall we have all the conditions in place to promote digital wage payments, or shall we require employers to pay digitally and then everything comes into the picture later on? And this is exactly what happened in the UK 40 or 50 years ago, I don't know exactly. But it became a requirement to pay wages digitally. It was a lot of challenges for the employers, for everyone at the beginning, but step by step the infrastructure evolved, the consumer protection and data protection frameworks evolved, and it worked out. So I think the excuse of saying, no, we can't do it because the conditions are not in place doesn't really hold. Thank you.
Thank you very much for this. So, change of subject, want to go back for a moment to the mobile money accounts. So Leora, so now I'm finally going to reach you again. So are there actually changes? I mean, that's one of the topics that was not discussed in detail in the presentation, but are there changes in how people use mobile money products? Okay, because it all started mainly with transfers, but are there changes in how this is used now?
Well, so as I mentioned, certainly it's being used more to receive payments. Governments are using mobile money accounts for government payments, subsidies, wages, private sector wages, and this large use of savings is also interesting. Can I make a comment on the last conversation?
Yeah, sure.
So, and if you want, I can give the last slide to Chris later. No, so around two very good points around the importance of the regulation. So something that's interesting, I could be a little wonky about it. So there's supply side data on financial inclusion, which is the number of accounts which banks provide to the regulators, and the IMF publishes as a financial access survey data, FAST data. And then you have demand side survey, which we collect. And there's often a really big gap between the two numbers. And governments often say, oh, your data is wrong because the other number is higher. But it's actually really interesting to understand that gap, because the gap gets back to what you both mentioned, that it's not only important to encourage account ownership, but also the use cases. But even more so, what's special about demand-side data is it's people's perception that they have an account. So for example, in the first round of data, Mexico had already digitized all government payments, and we found only half of people who received the government payments said they got into an account. And so I got nervous. But then there was an IADB report talking about how banks, rather than build local, so the government digitized their payments to banks, but rather than build local branches, they were driving sacks of cash out to rural areas and doling it out as cash. I mean, one can also argue whether the banks wanted poorer customers because they're less commercially viable, right? And so the same thing's now happening in Pakistan, for example, where you see this big gap. The government has digitized, especially a payment called BIS payments, which are to poor mothers, a very successful payment to target mothers with subsidy payments. And what they do is they have tables in the central square where a woman lines up, and she gives her thumbprint, and she gets handed money. And so my colleague actually was just there a few weeks ago doing these qualitative interviews with women who all said, how did you get your money? Oh, I get it in cash in the center square. And so the woman doesn't even know that there's a bank account behind that payment. And my perception is this is also going on in India and other countries. I mean, it's a combination of, let's be honest about it, if banks get the fees from the government, but poorer customers aren't necessarily commercially viable, plus it costs a lot of money if they're going to use a lot of time at the teller. It might be cheaper for the bank to distribute the money at Central Square. Agents, there's also often a lot of informal payments going on in terms of the agents like for example, in Pakistan, the women who are using ATM cards said, it's just the routine, I have to give a little payment to the guy standing next to the ATM machine. And so all of these are creating additional costs to the poor people we're trying to get the money to. And so it's absolutely the regulation to make sure that these programs are designed right. B, it's the education, that the workers know they have an account, know how to use it. But it's also the product design. It's also working with the private sector to make sure that these products are designed for perhaps the people with the least education, the most vulnerable populations. Thanks.
Thanks a lot for that, Leora, for this edition. So we're soon going to give the floor to the audience, but there's one more topic that I quickly wanted to touch upon, and that's inclusive growth. Because one of the aspects that's often put forward is that it was also mentioned already before, that if we want to make sure that SMEs can play an important role in creating employment, and in that way in creating inclusive growth. So Chris, what steps should financial service providers take to ensure that small businesses can also take advantages of all the services that we've so far discussed?
Well, I'd go back to the point that I think we ought to think of these mobile money and other kind of payment systems as platforms, and the platforms are going to have a lot of stuff built on top of them, and I think we're starting to see that now. It's mobile money and Pesa and so forth have been around for a long time, but I think we're beginning to see increasingly companies that are reaching out to SMEs of various sizes, sometimes micro enterprises, sometimes slightly larger enterprises, with payments platforms that they can then load things on top of. So, again, I think about a company in Nigeria, another in Kenya that are using, they're working with point of service terminals that do all of the financial transactions, the digital financial transactions for companies, and then kind of build onto that a set of business tools that allow you to sort of move the payments directly into accounting systems, and then are going to layer on top of that a lot of sort of machine learning kinds of data analysis of those payment platforms that will allow them to design and marketing services, accounting services, other kinds of business services that they can market to the companies based on exactly what their transaction things are, in addition to loan products and so forth. And I guess if I think about what do I think is likely to happen from that, I think it's kind of early days. So we in these kinds of things. So we'll, it kind of remains to be seen. But I suspect that at the upper tail of sort of ambition, ability, size of these enterprises, the access to credit, the access to these tools is going to allow businesses to expand quite rapidly. You're gonna see growth that comes from this, because you'll see that these are the companies that really are constrained, both constrained in terms of access to credit, but also constrained in terms of access to information services information systems that allow them to sort of organize a larger firm, and so at the top end, I think we're going to see growth and see. I suspect that we'll also see. I mean, one can worry, and again, I think this is a place where regulation, can plays an important role. One can worry that I can use ML to basically perfectly price discriminate and extract all the surplus that comes from lending, and so things like the universal payments interface and so forth that allow more competition. Probably are going to be pretty important in how this plays out. If I think of this as being information that's sort of constrained within a given payments platform, it's going to be that payments platform is going to have a lot of market power within its customer base, especially once that customer base locks into all the business tools and other kinds of services that they're using on that platform. So I think the regulatory structure again comes into play as being quite important. I suspect we'll see some people, some small share of the customers fall into kind of debt traps. We'll see some relatively small share, but an important share grow, and we'll see a lot of growth, and then we'll see the rest that kind of make use of the lending from time to time in ways that might sometimes be positive and might sometimes be not so positive, but that's kind of that's at this point kind of speculation about what'll come out of these systems. But again, I think it's important that we think about how we get competition built into these platforms, because people are going to get locked in. There are going to be relatively high switching costs of moving from one platform to another as people begin to use these specific providers.
Okay. Thanks a lot for Chris. So Liliana, you already touched upon it before, but is there something you would want to add to what Chris just shared with us?
Yes, I think competition policy is an important aspect. We see in some countries you have like a duopoly, or you have some banks that basically serve the market, make it very hard for new digital financial service providers to come in. So that's on a regulatory level an important point. But then development finance institutions can play a role. You mentioned BII. We have in Switzerland CFM, the Swiss Investment Fund for Emerging Markets. That's the Swiss DFI. And through their investments, they can support successful financial institutions to actually grow and make a contribution to financial inclusion. For example, in the case of Nigeria, CFM invested in Novastar Ventures Africa Fund 2, which is a regional fund, and then the fund invested over $11 million in MoneyPoint, that was former TMAP. And they helped the company to become the largest provider of financial services to Nigerian SMEs, and to really build also a presence in areas with very low banking penetration, where the majority of the population actually lives. And so that's really also an important part that DFIs can play. But then there are other areas, for example, remittances. There we worked in Ghana through a challenge fund, and then startups and new actors in this area through a challenge fund, so a competitive process where they also had to put some money on the table. They got some support to develop new financial products like micro savings, microcredit, microinsurances, and to bring down the costs to send remittances. So this is also one way we can support the market development. And a last example I would like to mention is I think, a very powerful one, and that's how to support small holder farmers. We have seen in agri-finance that it's really difficult for financial institutions to make a profitable business out of it. It's very difficult. So one way we have found a solution with IFC is to create a crop receipt system. So we have introduced that in Ukraine before the war, where you have a registry, and you need, of course, all the legislatory work to be done to be able to have these crop receipt registries. But you can basically use future harvests to then get access to a loan to buy, for example, fertilizers or seedlings and so on. And so the small holder farmer goes to a financial institution, they can access the registry, which is nothing else than a movable collateral with all the information on who it is, who owns the land and where, so you need a cadastre that works properly for which crops and so on. And within 8 years from when we started that, and it was rolled out in the whole country, more than 8,000 crop receipts were issued, and more than $2 billion in US dollar was in financing was accessed. So this is a really good way to go around it, and we plan to introduce it in other countries to help really farmers accessing money that otherwise is very difficult.
Thank you very much for this. So I'm out of questions. So we're going to open the floor to the audience. So a lot has been said already, but are there any additional questions? Yeah. Jess.
Thanks very much. And this may start by being a question for Leora. We heard a lot about remittances, about using mobile money, digital money for savings, for wage payments, but less about using mobile money for purchases. And until purchases really are part of the equation, then cashing out continues to be a major part of the ecosystem. And so I'm wondering, first, what we know about the trends in point-of-sale transactions, and if we know anything about how those trends address gender and education gaps, the sorts of things that you talked about. And second, what we think is the role of the private sector in both promoting and enabling those sorts of point-of-sale transactions, and also increasing the liquidity of that agent network, at least during a transaction or a transition period.
So that was a lot of questions. Hi. So apologies, I put up a lot of slides. So there was a slide on the use of digital merchant payments. What we know is that there was an explosion over COVID, especially in some regions. I was actually most excited to look at Latin America. As I mentioned, it's actually a nice Cisco measure, country level, on they call digital readiness. And we actually see a tight correlation with the adoption. So countries that had the infrastructure beforehand, but these issues around taxation, formalization, prevented small businesses from adopting, they did it when they had to, right? So now, of course, the question is if the only benefit is going to be potentially a higher tax base, will they continue to accept digital payments? That's why I really think this development of the various embedded finance models, offering them credit, is a way for them to continue to access, to accept the digital payments, right? So the supply and demand. I think some of the perception, at least in Latin America, was that it was probably a lot the supply side, that firms didn't want to take digital payments because they didn't necessarily want that transparency. It's also a region where an explicit policy of the government is to go after informal small firms for taxes, although many large firms don't pay taxes. So there's a lot of supply challenges. There's also, of course, the demand side. When we ask people in Africa and Asia why you, and what she asked, adding a nice question next year, why you don't make digital payments. Thank you for setting me up. What we hear most commonly is, I don't trust the system, right? So if you're a merchant and the Wi-Fi is going in and out, or I'm sorry, the connectivity is in and out, and the connection doesn't work, the customer may refuse to pay again. I already paid, I'm not gonna pay again, and so you'll never get paid. And so there's the quality of the network is very important for merchants as well, and also for consumers, to pay. I think that gets around a lot of those challenges. I forgot what I was going to say. There was an end of, something at the end.
Agent liquidity.
Well, no, that I don't have as much to say about. But no, so yeah, right. But it's certainly the development of that infrastructure, as you mentioned, really is critical.
Can I?
Go ahead, Xavi.
So a couple things. One is, on merchant payments, so one way to get around merchant payments, because the licensing of a merchant might be different is actually a P2P to a business, right? So, I want to buy oranges. Instead of paying cash, I just, I pay them with a P2P transaction, right? So now the problem there, of course, is there's fees, whereas a merchant payment does not have fees. But more, and going back, Leora, to your, so I wonder whether this growth in merchant payments are in places where you don't have a mobile money system, or where the mobile money is prevalent, but actually you have another fast payment system, which is basically bank account based, like Pix in Brazil, like UPI in India, and like in other countries that might be private, right? So UPI Pix is publicly and actually experiencing tremendous growth. Whereas, and others, again, all private one, like, in the US would be Zelle. I think in Europe there's, another name for it, I forget. But in other words, so, and there's a huge difference between mobile money that relies on these human ATMs, like the agent, right, that constantly converts cash into mobile money or digital, digital currency, to these fast payment systems that basically, once you're on the system, once you have the money in the accounts, then you rely only on that money, right? And in fact, there's papers showing that in fact, India during the demonetization, there was massive growth and persistent growth on the use of people using these fast payment systems, and then being on that without resorting back to cash, or other papers that show that when there were attacks to branches, that all of a sudden they had to shut down the ATMs. Actually, they were, because they robbed the cash in the ATMs. All of a sudden, you had more of an adoption of these fast payment systems, right? So you don't have to rely back and forth between cash and stuff. So the question is, to what extent does actually a system that relies on mobile money actually prevents the transition from cash to digital payments, right? Sorry.
No, so everything you said is quite interesting and right. I don't have an explicit answer. One thing I can mention is that we're hearing a lot more in countries where taxation is the priority as opposed to the digitization, of personal mobile money accounts being shut down if they're being used for business purposes. And so you think about the China model, which is extreme for other reasons. WeChat, Alipay is really a P2P payment mechanism that's been adopted widely by informal firms. You can't buy noodles on the street without flashing a QR code. Whereas certainly there are other countries in Asia and Latin America where that's being explicitly prevented. So that's, I mean, my hunch is that that's also related to the adoption of digital payments for these processes. But if I was just making Jessica's your other question around policies to encourage digitization. So to make more of the questions and the answers are yet, but a really interesting global example is Korea. So Korea gave tax incentives to both the buyers and the sellers to adopt digital payments. So sellers got to deduct their digital payment receipt from their VAT tax. Consumers got to deduct it from their tax base. And so actually, Pierre Bachas and I are working, we have a PhD student in Korea embedded in the tax authority. Hopefully doing the first really rigorous paper, we have access to millions of tax records from both individuals and businesses to study, sort of what was this wedge, and also, and also what was the impact potentially of digitization on tax evasion and tax revenue. But I think, but definitely there are policies, and there are other countries considering these various tax incentives, if that's the policy goal, have been successful, at least in the outcome of digitizing payments.
I just wanted to add on that. So I just had come back from a trip to Kenya, and one of the companies I talked to was one that is just like MoneyPoint and doing the same thing as MoneyPoint's doing. And Kenya, because M-Pesa is 95% of digital transactions, you do seem to see a lot of sort of business. It's not all cash out anymore. It's money moving within the system, and it's all sort of basically M-Pesa. And maybe one of the things about mobile money is in a lot of places it's more fragmented, and so you have people coming across platforms. It makes it harder to do the business transactions, so you do get cashing out and then putting the money back into a different platform. And then it's the UPI type systems that allow these systems to communicate with one another that become important. You don't need that as much in Kenya because M-Pesa is 95% of the market, so it's basically the whole thing. And certainly the government is I mean, we pulled up to a park to go for a run, and you could only pay with M-Pesa, which of course we couldn't do, so we had to get out and pay with a credit card. But at the car, the terminal's only, so there are lots of places where they are really pushing M-Pesa. And then we heard stories that a lot of the businesses are now have signs up saying we prefer cash, and that's basically a tax, basically for tax reasons. But there doesn't seem to be the problem of mobile money is the problem, maybe because it's not a fragmented system, and maybe lots of places where it is, that becomes the issue.
Okay, we have a final question here. There were two final questions.
Thanks. I'd like to ask a little bit about interoperability, which was touched upon lightly. That has significant implications for financial inclusion, making it easier for individuals to do account-to-account payments. But I'd love to hear a little bit more about how that changes the market structure of mobile money and the implications for financial inclusion, especially in terms of the different cost structures that firms might face.
So can I say something about that? So I'm gonna embarrass both myself and somebody that I was talking to a week ago that I can't remember who it was, who told me about a project they're doing, which basically sort of says interoperability cuts both ways. So the fact that you have these sort of islands of monopoly, it gives the mobile money that gives the people an incentive to build out the agent networks, which is very important, so that you get more access but at a higher price. And so once you go to interoperability, you take away those rents, and you get the network being built out much more slowly, but you get a lower prices. And so there's a trade-off there, especially early in the game. Now, if you can, I guess like a patent system, allow not interoperability for long enough to get to have the rents there to build out the system, then at some point you probably do want to switch to sort of having interoperability, so that you bring the cost down with the networks built out. But there is at least initially that trade-off between the two. between the two systems.
Okay. I have so the interoperability is both between mobile providers, which I was just in Malawi and was really blown away just how expensive it is. So they have interoperability, but it's very expensive to transfer. But it's also the interoperability between banks and mobile money accounts. And that's exciting. I mean, there's a lot of work going on in Ghana, for example, where there was a period where the banks weren't, the mobile money providers typically have to hold a cash deposits, and the banks couldn't access didn't want a deposit base, right? And so there were ways of effortlessly sweeping your money processly between your mobile money and your bank account, and the banks and mobile money providers were splitting the difference on the margin. And so this interoperability between banks and mobile money providers, which is growing in West Africa in particular, offers some nice opportunities for people to develop. You can think of mobile money agents almost as agents of the banks in the sense of bringing the customer base, but the customer could ultimately get a wider menu of financial services.
Yeah, just to briefly add, I mean, we have in principle a preference for competition and interoperability, and like the M-Pesa model was in a way that, you know, they got from one donor agency the grants to build up, and it went very fast, and we have great results, but it's basically then you have a very dominant player, and that's exactly the trade-off you mentioned.
Okay, is it a very quick question?
Yeah, very quick. And thank you, panelists. My question is on CBDC, the central bank digital currency. So going forward a little bit. So I guess we kind of see how it fits into the theme of just leveraging technology for financial inclusion. But do you see any forthcoming, I guess, disadvantages of adopting CBDC in terms of financial inclusion? Thank you.
Somebody had to ask it.
You want to answer it?
I guess just to
It's a
wrap
quick
up the
question, but a
session,
difficult question, clearly.
it's yet to be determined. The central bank currencies are very different from the Bitcoins out there, with different regulatory, but regulated CBDCs, at least in some markets, have potential to reduce costs for users.
So that was indeed quick. Thanks. Okay, so thank you everyone for being here tonight. We're holding you back from dinner, so we're no longer going to do that. So thanks a lot to the panelists. Yeah, Valerie has disappeared. But yeah, Chris, Liliana, and Leora, thanks a lot for being with us tonight. And we wish you all a beautiful evening. The sun came back, so the lake is waiting, I would say.